anymore. But it's very much a supply side story. We're looking at finance and increasing, or building a social capital market from a supply side perspective. And there's a couple of very important missing tools or links there, and the biggest one is the demand, of course. We talk about due diligence and so on, and yes, of course, every investor is going to do the due diligence, whether it's a social investor or whether it's a mainstream investor. They don't want to lose their shirts in one case, and they want to make sure that they make their social return in the other. And you reference all the time constantly to risk mitigation. One of the ways to mitigate risk is to work in a more coordinated manner with those on the demand side, and there's a legacy for that as well. Your work with the REDF goes back to the 90s. If you wouldn't have dreamed that you would have had this kind of a talk today at that time. I was working at the time, very early 90s, in microcredit. I'm an academic, but I, with a group of other people, founded the first microcredit institution in Canada. And we were really, it was baby steps trying to figure this all out. We would never have known where to go or where this would go. But our work, and this is my own experience, and many of us in Canada, was to work very closely with intermediaries who were able to help on the demand side, not just to identify, where the investment would take place, but also to work with these potential initiatives. These, call them whatever you will. Again, we have a duck problem: social enterprise, cooperative, community-based enterprise, but to increase the investment readiness of these, in many cases, fragile enterprises at the time that were redlined and had no access to any kind of investment capital. If we fast forward, those intermediaries have grown. In the States, when I think of the, I think they changed their name, but it used to be the National Association of Community Loan Funds, now the National Community Capital Association. These are trade associations that provide help on the demand and on the supply side. I think this is a critical absence in a new risk, that if we build a social capital market that begins to go belly up because it's doing all kinds of good things without the preparation of the enterprises, the organizations that they're going to invest in, notwithstanding due diligence one-on-one, this is a very high risk. So the risk mitigation can certainly be addressed, and I see George nodding. This is the reality of communities, to be able to integrate social finance into territory, into space, where we're despatializing a lot of this. When I'm sure in your early REDF work, you were in communities, you were in neighborhoods. A lot of this is despatialized. I'm a big fan of the IRIS also, and I participate in their webinars, and I've learned enormously, and they're very sophisticated, and it's interesting. But it's a worry because it's not going to be hedge funds. These are not the same kinds of people. But there's a risk that it's going in that direction, in the sense that it's very technically seductive. It works, and it's very interactive. It has this wiki component to it. But the distance becomes even greater. So I think what I'm saying is, for all of us who are, whether we're practitioners or whether we're researchers, we can't do it all. We have to work with people like you and others who are the architects of this social finance, but we've got to bring it back into communities. And then the other point I'd like to make is that there also seems to be, and here I'm caricaturing in some ways, but there seems to be a one-size-fits-all approach to this, and it's mostly, if not entirely, debt instruments that we're talking about. And this is a problem too. And if you go, if we leave the big picture and go into a community, in Ottawa or in Montreal or New York for that matter, again, there's an absence of consideration of the need for a diversity of different kinds of financial instruments, from debt to equity, and quasi-equity in between. And that's where you do need, legislation and legal form becomes really important, because you're creating hybrid kinds of instruments that people don't fully understand. I had this experience. We created the first quasi-equity investment fund in Canada that invests in cooperatives and nonprofits. And the investment stays for 15 years. So because we realized that all these short-term debt instruments were preventing a lot of these enterprises from growth, from consolidating and from growth. And at the other end there's a pre-startup. So the question of the life cycle of these social enterprises, whatever we want to call them, I think is critical. The diversity of vehicles is critical. The linking of demand and supply and working through intermediaries where they exist, pushing to create them where they don't exist, because they don't exist everywhere, is critical. And then the other missing piece, and again, I was happy to hear you say these are context specific. We can't compare Germany to the U.S. or to the U.K. And yet these models are often taken very much from the UK and the US, because there's so much work going in that area. But if we look at the UK, particularly right now after the election, and the US, where there's incredible initiative and innovation on the ground, but very little government engagement, these intermediaries, where it's possible, can work more closely with government to negotiate the kinds of enabling policies that would be necessary for all this to continue to work. So I suppose it's really an agenda for further or complementary work that has to be on the demand side, on the policy side, looking at risk mitigation from a different perspective. Although I think that your point is so well taken that these days the risk of investing in a bad initiative is very, very high. Mm-hmm. So I think I'll stop there. Just some comments.